Today we are recording the first episode of the Baird Retirement Management Podcast. Kicking off our first episode, we have Scott Bartosh and Greg Ashcroft from the Ashcroft Pesek Bartosh Group. Scott is a certified financial planner and is a director with the Ashcroft Pesek Bartosh Group. Scott has worked as a financial advisor for over a decade. Greg is a chartered financial analyst, a certified financial planner, and is a senior vice president with the Ashcroft Pesek Bartosh Group. Greg has worked in the industry for 9 years. Today, Scott and Greg will be discussing the impact that an election year can have on investing. To kick things off, let's tackle the question on most people's minds. Is investing in an election year so different than investing in any other year?
I think when Scott and I receive this question or questions of this variety, the implicit question really is, what does this mean for me? And I think when we have discussions of this nature with clients, when we're saying, hey, it's an unusual year, it's an election year, the first thing that we would want to do is, particularly in election years, is validate their fears. Election years have historically, and this year is no exception to that, brought with them additional volatility, and that's certainly been true this year, and we've seen it in the equity markets, especially recently. So I think investors experiencing some discomfort as we sit here 90 days out from the election is entirely valid, and that we need to go about the business of deciding whether or not that would warrant any significant changes in their case.
Well, and I do think, Greg, that you mentioned the discomfort of investing in an election year. I would tell you that, is it more uncomfortable than 2022, where we saw equity markets go down 25% pretty much across the board, or 2020 when we had COVID in addition to an election year? So I think I would agree, let's validate concerns here, but the general answer is no. Investing in an election year is not truly different from investing in any other year.
And I think Scott makes a great point, because as an investor, you're always going to be investing during some time. There's always something going on. So we had, like Scott mentioned, we had COVID. And then in 2022, it was a midterm year. On top of, we had stocks and bonds both turning in, performances that we hadn't seen in a year-over-year period for quite some time. Maybe the worst performance we'd seen collectively since the financial crisis. So whenever you are investing, you're facing some trial. And this year is an election year, and I think one thing that can tend to assuage fears is if we return to history. And so one of the things that we did was we just did some research on the topic to discover how have election years been fundamentally different from typical years. And like Scott mentioned, we discovered that the differences were really not that compelling. In terms of turning in negative results at the end of an election year, not even 2020 managed to do that, because the recovery coming out of COVID was so dramatic that those investors who stayed the course with their equity investments in particular actually experienced, a 20% year in the S&P 500?
Very positive.
But in only 2 of the last 20 election years have we seen negative results on the equity side, and that was 2000 and 2008. But I think even lay people in the investment world would look at that and think, well, I don't think that the administrations had really anything to do with what was really the tech bubble kind of coming undone, and then the financial crisis. And those were just, again, that's 2 of 20 last election years have turned in negative results, and they don't really have anything to do with the election.
Yeah, and I think, kind of going into history a little bit more, in addition to 2000, you had 9/11 that happened shortly thereafter. That led to some difficulty in the markets for quite a long time. And then 2008, really into the last few election cycles, we've had this experiment of super low interest rates that lasted for a decade, pumping a lot of liquidity into the financial markets, pumping a lot of cash into the financial markets, especially since COVID. So I think the question's more fundamentally, is the economy different today than is investing in an election all that different?
And Scott, on that point, this was something interesting, which was historically during election years, and this is largely because investors are fleeing volatility, we've seen massive inflows into money market and similar oriented funds, which are very short-term, very secure cash investments, essentially. And that obviously has been on the heels of outflows from equity markets. Since we are facing somewhat not an unprecedented, but an unusual period where inflation has been a persistent problem, Do you think that investors, if they do flee equities and into these cash-like investments, are they going to compound their issues by inflation?
I think it's possible. One of the things that I'm somewhat concerned about is on the other side of maybe this election, do we see inflation creep back a little bit more meaningfully? In the last several data reports that have come out, getting closer to the 2.5%, 2% target. But I think a lot of individuals and people that I work with are saying that I still feel it at the grocery store. And to some degree, it's a cumulative effect. And that's not going to change overnight. It's going to be years of lower inflation before people start to feel the difference in their buying power. But I do think that's a problem. That $6 trillion in money market funds that are yielding 5%, it's continuing to fuel the fact that there's just a lot of money in the financial system right now. So, yeah, that's one thing that's fundamentally different than, say, every election year since probably 1996.
Yeah, and I mean, like Scott mentioned, money market funds were already at historic highs leading into this year. And so if we see even more inflows into money market funds coupled with persistent inflation, I think that we can turn the desire to escape short-term volatility into a long-term issue, which is you flee the equity markets at the wrong time, because often investors leave the equity markets too late and they fail to get back in because recoveries are often not smooth. They are asymptotic on the front end, and then we see some plateaus and fits and starts as we get along, and many investors compound what could have been short-term discomfort into a real long-term issue for their portfolios.
And I would add to that today, talking about volatility, I feel like it's even more impactful because Monday was the most volatile day in the market we've seen in, I think I read that based on the VIX, it was the most volatile day in the market, excluding COVID and the financial crisis since 2001.
And Scott, just for those who don't know, could you clarify what the VIX is?
Yeah, so similar to how the S&P 500 is tracking the performance of the 500 biggest companies in the U.S., the VIX really is an index that measures market volatility on a daily basis. To
sort of recenter the discussion on volatility with answering the question that was posed to us, which was, is investing in an election year fundamentally different than any other year? There's a yes and a no component to that. The yes piece of that is volatility is higher during election years. There's just no denying that. It's been historically higher, and this year is certainly no exception. However, if we look at history and see where in an election year is volatility, where does volatility tend to concentrate, historically it's been during primary season. And that will have generally wrapped up by the end of May. This year, Scott, do you think it might be a little different because we had such a late stage change in who was running on the Democratic ticket?
Yeah, I was going to chime in on that. Really, this entire both sides of the aisle, there wasn't much of a primary season. I mean, we had an abbreviated Republican primary, really nothing to the Democratic primary. Now we have a 11th hour change where Kamala Harris is going to be running. Just yesterday, she announced Tim Walz as her running mate. We'll see how that impacts markets. Most important thing this week, I think, is the volatility that was created by some changes in the Japanese situation where they raised interest rates for the first time in a long time. There were people who were borrowing money in yen, investing in dollars, created kind of a ripple effect that added some volatility. But I think that the short answer is that, yes, I think we could have some condensed periods in the next 2 months where volatility is a little bit higher. Historically, October is one of the more difficult months in any year in terms of just total performance, overall volatility numbers. So, yeah, I think we could have a little bit of a condensed volatility run-up in the next couple of months.
And, Scott, on the Japanese note that you made there with them taking interest rates up for the first time in a long time, do you think that program trading could have played a part in the dramatic spike we saw in the VIX? And Do you think that this really betokens some dramatic recessionary pressure that we're going to feel here in the United States or in Japan or worldwide? Do you think there are systematic spillover effects from what we saw in Japan, where their equity markets really suffered, while in the United States we had kind of a lighter version of that? Or do you think that was just kind of a one-off blip, largely produced by very sophisticated program trades that are sensitive to these very minor changes in fundamentals?
Yeah, I think if you look at the fact that the Nikkei index was down more than 10%, and then the S&P was down about 2.5%, 3% on Monday, I think it does show that the biggest impacts were from some of those very specific instances where probably margin got called. There were instances where people were a little bit over-levered because of the way they were borrowing money in that particular economy. And then I think you're right, program trading, it just is increasing volatility across the board. The option markets are so much more robust than they were, say, 20 years ago, to the point where we've got these one-day options that people like to play with, and 0 days to expiry, where you're basically just making a bet on what's going to happen today or tomorrow in the markets. And that's going to contribute to some volatility over time.
Okay. To end on just a little bit of a lighter note, more optimistic note, which is, despite the volatility that we've seen in election years, stocks on average have gained 11.3% in the 12 months following the end of primary season. And that's traditionally using May 31 as a start point and end point. I think with the things that are unique to this particular election cycle, we might see volatility persist beyond that stage, and maybe the point-to-point returns from May to May might not be as good as they'd been historically, but it wouldn't surprise me if point-to-point returns starting in August or September contours to what we've seen historically. Now, obviously, this is no guarantee that that's going to happen, but just so people can put into perspective what the 12 months following an election typically hold, stocks have returned on average 11.3%.
Well, and I would also add to that in this particular case, like all of the other ones, as we're kind of pointing out, there are other factors at play. Technology stocks have rallied immensely over the last 18 months. So if the next 12 months are poor for technology stocks, does that say it's because of the election result, or is it because they've run to a level where NVIDIA and Microsoft and some of these companies are priced for perfection moving forward? And if there's a little bit of an AI blip down the road, I think some air was going to be let out of that balloon regardless.
Can you give me some specifics on how this affects different sectors?
If we turn to history to take a look at which sectors have largely experienced the most volatility in an election year, it isn't at all surprising that those sectors have been energy, healthcare, and financials. And the reason that this isn't surprising is that these sectors specifically have been used as political footballs for a long time. We know that energy has faced some pretty dramatic headwinds in terms of regulation from time to time. We know that healthcare is a constant policy question, which is how are we going to administer healthcare in this country? How are we going to deliver it? How are we going to pay for it? And then financials, I think sometimes warranted, leading out of the financial crisis in particular, have been the subject of close scrutiny. So those sectors have historically demonstrated the most volatility in an election cycle. However, is this year going to be different?
Yeah, and I think going back to what I was saying about technology, it's tough for any of those sectors to compete, in my view, with what we could potentially get from the high-tech sectors, given the exuberance in AI, and given that these companies, some of them are priced at 100 times earnings or more. I mean, if there is even a tiny blip in terms of the earnings stream or regulatory issues, we've recently seen Google and Apple have big decisions come down against them in Europe. It's going to be challenging to do business in Europe as we go forward, and it's a regulatory question. I think actually one really interesting part of this whole election discussion is the regulatory aspect, because if we think about going back to the 2020 election, if you were on the Republican side of the aisle, you probably didn't feel like Joe Biden winning was going to be great for energy. Not as pro-energy policies, maybe shutting down pipeline projects, things like that. But what we've actually seen is since COVID, a lot of those companies have done really well. Part of that is a scarcity impact. There's less new drilling than there was maybe in 2018 or 19 before COVID. And so therefore, the price of oil has gone up. Granted, there's been the Ukraine conflict, lots of issues in the Middle East too, but sometimes there are unintended consequences to elections where it might have felt great for kind of the green energy people for Biden to win, but it ended up producing record returns for energy companies.
Yeah, and I think you make a good point because somewhat surprisingly, you have these sectors that have historically demonstrated high volatility in election cycles or election years in particular. But as it turns out, healthcare, energy, and financials have largely thrived in and under various administrations. And I think as the point you were making there, Scott, is it's really difficult for an administration, no matter how popular, to overcome the basic economic fundamentals and the basic economic forces that drive the performance of these sectors. And so I think that in something as fundamental to our economy as energy and something as fundamental to our economy as the financial system and as healthcare, I think that sometimes we overweight what administrations can do. And because we overweight that, we do see some short-term deviations from their long-term fundamentals, but that doesn't last very long.
Something we commonly hear is stay the course. What's your opinion on this sentiment, and how does investor behavior affect investment results?
I think on the question of stay the course, it's often the case in investing that the sentiment is don't just do something, stand there. And while that can be blunt and while that can be unsatisfying, we really can't escape what history tells us. And this opinion is shared by various active managers or various managers, and these are managers of all varieties. So we have a passive group like Vanguard and a very active group like Capital Group. They have very different investment philosophies. They have a different investment thesis, but they share this opinion, which is in an election year, the investors that have on average over the course of history done the best are those who have stuck to their plan despite the volatility. And I think that the question that we are trying to answer as a financial advisor or an advisor working on your behalf is, let's set aside the fact that it's an election year. Have the fundamentals of your plan changed? Have your needs changed? Is there something on your own personal horizon that we are planning around that we might need to take additional volatility into consideration in an effort to make that goal happen?
Yeah, and I would just add to that, Greg, that I think the big question I would ask is not buy or sell. Is my asset allocation still right? Is my portfolio designed to cover the needs for the next 5 years, 10 years? If I'm in retirement already, 20 or 30 years? And I think the answer to that might be some small changes, but it's not really because of the election. It's because we've gotten some nice results over the last 18 months, and volatility could be increased. That usually is a good period at which to say, all right, maybe I take some gains off the table, or maybe I look at fixed income, which, by the way, this has been, the last 12 months or so now since inflation kind of peaked in 2022. It's been a really nice time to invest in bonds. And people were really afraid of that after how badly we got hit by interest rates going essentially from 0 to 5% in a relatively rapid period. But I think as we look forward, you can look at, say, CDs or really short-term government bonds, corporate bonds, and get a nice return.
Yeah, and I think that the stay the course opinion is really a reflection of how good investing tends to be a sustained and systematic effort in error avoidance. And we think if you make big dramatic changes to your fundamental strategy based on who you think might be elected in November of this year, more often than not, it produces errors. So when we return to that question that we had at the very top of the conversation, is investing in an election year fundamentally different than investing in any other year? I think we can return to Scott's very succinct answer, which is the evidence tells us that no. investing in an election year is not fundamentally different than investing in any other year.
Scott, Greg, thank you both for taking the time to walk us through this today. And to all those listening, thank you. To make sure you don't miss any future episodes, you can subscribe to the Baird Retirement Management Podcast wherever you get your podcasts. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. This broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.